Alright, let's start. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh.
Alright. Meet you again on the marketing strategy class. And tonight we are going to discuss on the chapter 8 regarding all resources are limited. As we learned before, that we learn about the first marketing principle, that all customer differ. Principle marketing number 2, all customer change. Principle marketing number 3, all competitors react. And marketing principle number 4, all resources are limited. So we need to manage the resource trade-off. So in tonight's agenda, I will give the introduction about the all resources limited and what kind of approaches did we do, we are going to do to manage the resourcing trade-off, and then the framework for managing the resource trade-off. All right. So all resources are limited. Okay. So the final and perennial issues that facing the managers is that all resources are limited and often interdependent. So basically, this is referred to the scarcity of capital. The company resources is limited. We cannot execute all of the, let's say for clustering model, if there is 5 segments that you develop, it is most likely impossible for the firm to execute all of the 5 segments. We need to have a trade-off that because of the scarcity of capital, scarcity of resources, we need to optimize our resources to only execute one segment that interests you the most, that the persona need your product really much. So there is, because of the limited resources, we need to trade off our options to drop the 4 segments and execute the 1 segment. Managing resources optimally is also critical because the marketing resources provide the primary action levers that the firm can use to implement what they have learned from the previous 3 marketing principles. So in this chapter, we need to manage our resources optimally. We cannot execute all the segmentation, and we cannot execute all the acquisition, and then what is the E? Acquisition, retention, and expansion. Yeah, or we cannot do all budget. We cannot send out all of our budget to the branding, offering, and retention. No, we have scarcity relationship, yeah, board. So we have because of due to the scarcity of capital. So we need to manage our resources optimally. And the previous 3 marketing principles involve the trade-off, yeah, regarding the STP, acquisition, expansion, and retention. brand offering and relationship. Yeah. So we need to determine our annual budget accordingly to the specific marketing action that give the utmost wealth, give the utmost sales, give the utmost profit to the company. How many percent you allocate to segmentation? And then how many percent you allocate to acquisition rather than to the expansion or retention? Are you focusing on retention? Or how many budget do you allocate to the brand strategy or into the relationship? What is the optimum combination which gives you the utmost return to the company? So that is the objective of our class tonight. So specifically, we need to balance the marketing resources across the customer segments. Of course, we need to drop the 4 and select the 1 segment. Life cycle stages. Which life cycle do you prefer the most? Not dropping the expansion and retention, but allocate which one have the bigger weight. The weighted average. And then from the brand offering and relationship, what is the proportion for each of the marketing action? And then for the others, for the futures, sustainable competitive advantage on the R&D projects, or you want to do the changing the geographics of your sales, yeah, from Jakarta only, you want to sell it all over Indonesia, or what is your sales territories? One area cover, one province cover 3 provinces, something like that. Because of the resources are limited. Yeah. If any question, just shoot. So the source of needing to change resource trade-off is that there is changes in the customer's need. So we cannot say that I already allocate my budget, yeah, to this segment, yeah, to your selected segment. That segment, their needs also changes, yeah. In what stages of in that segment that you want to offer your products, yeah? So when the needed changes, then the budget also changes. Let's say when the customer change, yeah, and then when the customer change, when you are in the senior high school, you need only certain products. But when you are, let's say, what kind of products? Yeah? When the customer change, that also will influence the others. Let's say the branding strategy, yeah, the relationship strategy. So when the customer changes from the products into the services, yeah, they're more into the service, not only the product. Let's say you're selling the elevators. And then the customer change, they do not need just the product, but also the services. It also influences the other variables to change. Branding strategy also change. Relationship strategy also change. Because the customer change, you need to allocate more in the relationship, not only on the brand of the elevators. So that is the source of change for the trade-off. Life stage. And then the need for resource trade-off across the principles. So we have scarcity of capital. We have limited resources. So when we need to conduct first thing correctly. The first step is to select the segments. Selecting who is your segments and what kind of product do you want to sell across that potential customer. Yeah? So we need to conduct the STP, segmentation, targeting, and positioning. What kind of, when you conduct that, and then you have that segments, how do you choose the targeting segments? It is through the attractiveness and competitive strength using the GE matrix. Attractiveness, we have that in the size of population, the volume, yeah? There is attractiveness. And then competitive strengths, we can use the GE matrix. We learned this on the chapter 2. And nowadays, the improvement of this is that when the customer change, those segments can be separated into two segments because customer change. Yeah? Those big balloon separated into two balloons. So the trend is that it is getting smaller and smaller segments. Yeah? And also we can use another model using the CLV model, customer lifetime value model. So using the customer lifetime value, we can see the attractiveness of the cluster using the customer lifetime value. How to calculate the customer lifetime value? Remember, what is your income? And then what is the present value of your income? Yeah? What is the perpetuity income that you are going to have? Yeah? So we can identify the volume of value of the customer in the cluster. We need to do that right. Yeah? To make sure that when we do it right, meaning that the conversion of the customer into buying your product is more higher compared to the other segments that is not in need for your product, or the persona is not needing your product. And then second one is to select who and what to do across your existing customer. So, yeah, you recall that we have in the marketing principle number 2 that the customer change. Yeah, whether to see the stages of the customer. Is it for the acquisition? Is it for expansion? Or is it for retention? Yeah. So on top of the persona, on top of the persona is the acquisition, expansion, and retention. On this persona, what is the stages? Is it acquisition, expansion, or retention? how much money do you allocate for each of the stages? Yeah? How do you decide based on the CLV of the customer persona? Okay, if the customer persona they are new to the bank, so you need to conduct the acquisition model more, because this cluster is more dominant on the new to the bank. You need to conduct the acquisition strategy. So you need to allocate your budget more into the acquisition. Or if the portfolio population is more into the existing customer, you need to expand your product holdings. You offer the top up, cross-selling. Or if the transaction is lesser and lesser, you need to conduct the retention strategy. Yeah? So in current days, the improvement of this is that we can conduct individual customer level analysis, yeah? Or hybrid Markov model for the dynamic segmentation. Okay. And then on top of the persona, on top of the acquisition, expansion, and retention, on top of the BOR, brand, offering, and relationship. Let's say in the acquisition, okay, you are going to focus on the acquisition because this is new to the bank. What kind of brand strategy are you going? Which one are you going to allocate more? Is it the branding? Is it the offering? Or is it the relationship? Yeah. How do you allocate your money? Okay. So we need to make a customer equity stack of the branding, offering, and relationship. The decision criteria and allocation process can be using the regression model. Recall the previous week, that we conduct the multilinear regression to identify from the brand, offering, and relationship, which one determine the acquisition the most. You can do it with the multilinear regression. Okay. So by that we can identify, okay, in the brand strategy, which marketing actions on the brand strategy that we can determine the acquisition the most. Is it the advertising? Is it the word of mouth? Whatever. So we can use the multivariate models. Yeah? Multivariate models is also the other name of the multilinear regression model. Next is after we identify the segments. I identify the acquisition model, and then I set up the, let's say, on the relationship strategy. Next is determining the annual budget plan metric to execute the branding, offering, and relationship marketing strategies with the approach of the, we need to develop the measure metrics. What is the lagging indicator? What is the leading indicator? Yeah? Evaluate and adjust iteratively. Yeah? What do you mean by iterative? When we conduct the segment, and then conduct the IR, and then the BOR, and then we need to iteratively, after 6 months or 1 year, we need to check again the segment. Is it the same segment, or it is differentiated into 2 segments, separated into 2 segments? Is the segment behavior changed or not? So we need to do it iteratively. Yeah. what is the decision criteria on determining the annual budgets? We can use the marketing return on investment. Yeah. Using the response model, solver, and conjoint analysis, we are going to discuss that later. And the improvement nowadays is using the more inclusive response or optimization models. Optimization models meaning that after doing it iteratively, we can identify how much money we need to allocate specific to the board, specific to the each board. Yeah, that gives the utmost return to the company, which gives the most optimal return to the company. Using the iterative model, using the response model. If any question, just shoot. So all resources are limited. What is the fundamental assumption of the marketing strategy? So you as the marketing manager must recognize that all resources are limited. Yeah. All resources are limited. And an effective marketing strategy must manage the resource trade-off. Yeah. And then all resources are constrained. Even if a firm's existing resource allocation maybe appears effective, maybe. But there is unexpected changes in the macroeconomics. Maybe in economics changes. Technology from 3G is now 5G. Yeah? Innovation landscape. Yeah? So unexpected changes. That is will also making the company to quickly adjust in response to each of the new situation. Yeah. So we need to allocate also our budget to the unexpected changes. COVID-19 is unexpected changes. Yeah. A firm's marketing strategy must account for resource trade-off. So the marketing principle number 4, all resources are limited and an effective marketing strategy must effectively manage the resource trade-off. So far so good? Questions? Capish? Alright. So we are going to talk about the approach on managing the resource trade-off. So long time ago, yeah, there is what we call heuristic era. Yeah, regarding the information available to evaluate the resource trade-off, we have the heuristic era long time ago, 100 years ago, and data era, which is the current situation. On the heuristic era, let's say 100 years ago, it is very little hard data. Yeah, people in the heuristic data, they use anchoring and adjusting approach. What does it mean? The heuristic model. Yeah. So they are using the marketing resource, let's say sales, advertising, etc. Yeah. And then to achieve the marketing outcomes of the market share, sales, loyalty, etc. Yeah. So they just anchoring the budget, the allocation. Let's say, okay, we can use, using my previous lesson, my previous experience in a company. We just set up the budget for the direct sales is around 0.6% of sales. Yeah, 0.6% of sales. So if you are targeting 1 billion rupiah, meaning 0.6% is the allocation. So we use that number only, year through year. Whatever the sales is, the budget is 0.6%. So there is heuristic era. There is simple 0.6%, yeah, but there is what we call that simplicity, very simple approach using the anchoring model. Nowadays, we are now moving into the data era. There is what we call attribution approach. Yeah, that we have the marketing resources of advertising, the sales force, etc. There are marketing resources, and then there are marketing outcome of the market share and sales. Okay, the same data, but in the data era, we conduct experiments and response model. Yeah, we conduct experiment and response model to get the optimal allocation into our input resources. Optimal allocation to achieve the utmost market share, the utmost sales, the utmost customer loyalty. We conduct the model using the experimental model and response model. Okay. Okay, this is the Heuristics era and Theta era. Okay. So, let's see. Why the data era happened? Because because the technology is well developed. The infrastructure of data is becoming more bigger or becoming more sophisticated. Customer sophistication is from the uninformed customer going to highly informed customer using the social medias. Proof of marketing effectiveness from the trust only to high demand of mathematical proof. On the globalization from the local market into highly competitive global markets. So the trends have changed how marketers allocate resources. Yeah, due to these reasons. But the problem is there is no perfect system for allocating the resources. Okay, 6% of the budget of the sales going into the bar. 6% of 0.6% of the budget going to the sales. That's all. But it is not perfect. So the problem that we have is that we need to be simple enough so it is transparent to managers while being sophisticated enough to account for interdependencies across multiple time varying inputs, each with the different elasticities. So we need to be simple enough but sophisticated enough. The best methods that we have identified is the iterative approach. which attempt to make optimal allocation across nested level of decision. We conduct the clustering, conduct the customer dynamics, conduct the competitor GX, and then we iterate again to keep and it keep changing. Maybe a company can have iteratively once a year. Another company may do it once a week. Once a week. They need to be able to see the dynamicity of the market. So iteratively every week they change strategy, yeah, in response to the market. Let's say Traveloka. Traveloka, we have competitor like Ticket.com, Agoda, etc. If Traveloka do not react on the competitors, do not respond to the competitors' reaction, then let's say the competitor reduce the price, and then all the customer goes to that competitor only. They do not buy ticket from Traveloka. So Traveloka need to iteratively check it every hour to see what is the level of the price in the competitors right now. So how many percent we need to change? How many percent we need to decrease our price? Iteratively every 30 minutes. So the marketing activity is now changes. Yeah. And then on the heuristic data, heuristic era, the anchoring, there are 4 models that can be used that used to be used in the anchoring era. Yeah. First one is the percentage of sales methods, the one that my company used to do. 6% of the sales goes into the marketing resource. Or another company can use percentage of profit methods. Most likely the same, but not using the sales, but bottom line, the net income, the profit. How many percent of the profit? Let's say 10%, 5%, they dedicate to the marketing. Or also, some of company adopt the historical methods. Yeah. So last year, how many percent? Okay, increase a little bit from last year. Just all historical methods. And the last one is the mostly used model, competitive parity methods. What is the rate in BCA now? 10%. Adopt it. So you mean we use the same rate because BCA may be right. So that is called competitive parity method. Implies what the competitor did, or what is the rate in the competitor? The deposits 10%. Okay, adopt the similar rate. So that is anchoring approach, the heuristic approach. And for the attribution approach, there are 2 models. First one is the experimental based attrition. Yeah. So experimental based attrition is like the A/B testing methods. So there is 1 and 2. The one is the control group. Control group. The one is the one that is having experiment. Yeah. So on the control group, you do nothing. What is the result? You do nothing. And then for the experimental group, you conduct intervention. Okay, you allocate more budget into the advertising. You allocate more budget into the relationship. What is the result? What is the difference between control group and the experiment group? Yeah. So that is what we call experimental based attribution. Yeah. Okay, so in the experimental group, we conduct intervention, yeah, marketing action, yeah, we conduct marketing action towards the population, and the outcome will be the gain from from implementing the experiment, yeah, design when, where, and to whom the firm conduct the intervention, and control group, the one that remain unchanged, you do nothing, yeah. What is the result? So comparison between the control group and the experimental group, that is determine the gap of success rate or the performance of your model. The second method is using on the attribution approach is using the response model attribution. A response model attribution is using statistical model that captures the relationship between past marketing resource and past outcomes. The underlying philosophy is that historical data contain insightful information about whether and how much marketing resources truly increase the outcomes, which is useful to know when deciding on the future marketing action based on the historical data. You conduct the multilinear regression, yeah. Okay, last year the branding determine the acquisition the most. Okay, so let's pour some money to the branding actions. So that is response model attribution. So there are pros and cons on the resource allocation using the market response model. On the classical approach, yeah, on the classical approach, you use the heuristic model like percentage of sales methods, industry benchmark, yeah, last period reward and punishment. So this is a classical approach. Response model, we build black box model based on the past performance to change in the input. So you recall that there are y, x1, x2, x3, and then y equal to constanta plus beta times x1 plus blah 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 blah. This is the model, the response model, yeah, using the regression. But once it is built, then we need to optimize what is the changes, what we need to optimize for the at most y, yeah. Let's say y sales is 5,000, something like that, yeah. So I think you guys understand, yeah. Do you need an Excel model demo on this? Do you understand what I'm saying?
Still digesting.
Okay, on the response model. Okay, let me make an example using Excel. Okay. All right. Okay, you see my Excel? Okay, this is branding 1, branding 2. Okay. And then this is relationship 1, relationship action 2. Yeah. this is the offering 1, offering 2. Okay, this is the sales. Okay, this is run between 1 to 5 using liquor. Okay, this is the sales. The sales may be increase on, okay, run between 10 to 80. Yeah. Percent, yeah, let's say percent. So this is 100. So 100 master special values divide. Okay. So let me explain. So we need to optimize the model. We need to optimize to see the utmost return. The utmost return is when the sales growth on the on top, yeah. So let's say 62%. This is the utmost sales. So we want to know which branding, relationship, and offering which determine the most sales growth. So we conduct the data analysis using the regression, and then the input Y is the sales growth, and then the input X is the marketing action. Label, output range, and here. Okay. So we see that which one is the highest is on the, what's one? Branding number 3. Yeah? Branding number 3 having the highest coefficient, meaning that, okay, to improve your company, to improve the sales growth of the company, you need to spend more into the branding number 3. Yeah? And then we do it iteratively, maybe every month, maybe every 6 months, or maybe every year. So the budget allocation can be different every semester or every quarter. So far so good, kapish? Okay, good. Right. So we build black box based on the past response to changes in the inputs. Yeah, past response to changes in input. Yeah. Once the model is built, then we optimize for the objectives. Yeah, and then routinely. Okay, so the response model system has 8 key parts. First is the marketing inputs. So we have the branding 1 until 3, blah blah blah. Offering 1 until 4, relationship 1 until 5. And there is competitive actions. And that we need to develop market response in order with the output of awareness level. The incremental of awareness, how many percent increase from last year? Yeah, the sales level, how many percent growth? And then we put the competitive action of the competitors react and the environmental factor towards the data. Yeah, we can also put the customer actions. Yeah, they increase their sales, blah blah blah. So the market response. Okay, so what is the result? Okay, branding number 3 is the one that is determine the sales growth the most, and then we send it back, optimize and evaluate the increase evaluate and then conduct marketing, adjusting the marketing inputs. Okay, so we need to put, okay, let's say we put this rupiah into allocate rupiah. This one is 10%, something like that. Yeah, this one is okay, not 0%, because this is having negative relationship. So on the positive we put, okay, 5% from the allocation of budget. So we send it to the marketing inputs. And then we see again, okay, is there any result? Okay, and then we do it again after we conduct, and then the sales growth change, and then we conduct the regression again and see, oh, the customer change, they are moving into branding number 4. So let's change the inputs to change the budget for the branding 4 is going into 10%. This one going to 5%. Okay, the banner change. Okay, the affiliate marketing more, because affiliate marketing is nowadays having higher traffic, something like that. So this is the response model. Any questions on the response model? Araso? Araso? Questions? Emma? Kapish?
Still processing, Pak.
Okay. Right. So if you cannot measure it, you cannot manage it. So if you want to manage something, you need to measure. We do it using many alternatives. One of them is balance scorecard. In the balance scorecard, there is what we call lagging and leading indicator. So on the lagging indicator, like customer satisfaction, what is the leading indicator? Product focus, forward looking. On the service quality, what is the leading indicator? Experience and relationship focus. So the more relationship you have, the better the service quality that customer experience. The brand awareness, what is the leading indicator? The promotion and fast response on the customer complaint. The brand strength and quality, what is the leading indicator? The promotion, the price, product, yeah, slow response. Customer retention, what is the leading indicator? Backward looking, aggregate. Loyalty, what is the leading indicator? Best forward looking, something like that. So in order to manage it, in order to achieve the lagging indicator, we must focus on the leading indicator. Let's say loyalty. Yeah. So we want to create customer loyalty. Loyalty is an attitude and behavior that signal a motivation to maintain a relationship, where attitude captures the positive feelings and behavior captures the actual actions, such as repurchase, word of mouth behavior. So people, when they have strong positive feelings towards you, high, and they have a behavioral actual action that is high also, they repurchase the product, that is called true loyalty. When they have negative feeling about you, but they're still buying your product, that is spurious loyalty. They have bad feeling about you, but they still buying. Okay, spurious loyalty. If they have high positive feeling on you, but not purchase much on your product, latent loyalty. And if they are having negative feeling, but also very low purchase, no loyalty. Yeah. This is the measures of loyalty. In that loyalty, what is the matrix? So we come into one matrix which is we call net promoter score. Yeah? Net promoter is the percentage of the customer who are promoting your product. Yeah? How many percent of your customer promoting your product? And who are detractor. Okay. Let's say the question is, how likely is it that you would recommend a firm to a friend or a colleague? So if the answer is 9 or 10, it is considered promoter. Distractor is 0 to 6, while 7 and 8 drop. Yeah. So if the population of the 9 and 10s higher than 0 to 6, yeah, meaning you are a world-class company. If it is 70%, 75% of the 9 or 10, 75% or above, you are a world-class company. Yeah. So this is the NPS, Net Promoter Score, to see the loyalty measure of the company. So in this loyalty term, yeah, there are what we call 7 P's. Yeah. We are going to discuss this after the mid-semester regarding 7 P's on the service marketing. So there are people, place, physical evidence, promotion, process, price, and product. The 4 P was here: product, price, promotion, and place. Yeah. There are another 4: people, physical evidence, and process. From this 7P, if we would like to segregate them into BOR, then people and place will go into relationship. Physical and promotion will go into the brand equity, and the process of product, the price, and the product itself will go into the offering value equity. The 3 product, the 3 customer equity stack, relationship, brand, and equity and value, go into the loyalty, the Net Promoter Score. While relationship equity determine the service quality, and the offering value equity will go into the satisfaction, customer satisfaction. Yeah. Customer satisfaction on using the product. The loyalty itself will determine the accounting metrics, will drive the accounting metrics of sales, growth of the company, costs, and the profit. So loyalty is highly critical to the company. Loyalty level of the customer is highly critical to the company, because the more loyal, the more sales, the more growth, the lesser the cost, and the higher the profit. That is dominantly influenced by loyalty. So many marketing metrics, but 2 main approach. There are specific metric. Specific metric is what you control. Yeah, you control for the brand. You need to control awareness, the quality and strengths. how many people watching, notice your Instagram, your Facebook, yeah. So that is brand. So you need to this is the same like leading indicator. You focus on to develop your brand. You focus on the awareness, on the quality, and the strengths. On the offering, you focus on the innovatives, adoption rates, price premium, and value. Yeah, when your model showing that the brand determine the most, your allocation of money should allocate more into awareness, quality, or strengths. You can calculate it as well. If you are focused on the relationship, then your allocation need to the salesperson, direct sales. Yeah. For the acquisition, on the AER, you focus on the how many new customer to the bank. Yeah, new to the bank. Focus on the CLV. Focus on the stickiness duration. On the retention, you focus on the churn. How many people left? Lost customer. So this is specific metrics, the one that you want to control. There is also aggregate financial metrics. Yeah, what we call net marketing contribution. Yeah, this is more into ratios. Yeah, aggregate model, aggregate metrics is ratios. Net marketing, return on investment, yeah, debt to equity ratios, financial metrics. Yeah. So this is the types of metrics. Yeah. On the customer delight, there are awareness, the interest, the desire, the sales. How? Yeah. So you need to focus on this. Yeah. Advertising, visits, page views, click-through rate, etc. Salesforce, how many leads you have from the sales, conversion, how many percent, winbacks, distribution, stock keeping unit growth, etc. And then there are financial analogs. Yeah, return on marketing, return on investment, yeah, cost per leads, cost per click. So more into the financial perspective. Right. So that is all our topics on this. And then the framework. How to conduct the framework for managing resource trade-off. Yeah, the framework for managing the resource trade-off. We come back into the model. Yeah, you have the inputs of the three marketing principle. The customer differ, the customer change, and the competitors react. So you have the input of positioning statements, acquisition, expansion, retention strategy, and the board strategies. And then the process is using the two approach. Whether you want to use the heuristic approach, 5%, 10%, or the attribution approach. Yeah. And for the analysis in the attribution approach, you can use response model or experimental based attribution. Experimental is the A/B testing model. One the control, one the experiment. Or response model attributes, the one that is using the multilinear regression. What is the output of this? The output is how you manage your plan and budget. What is the budget for the marketing activity? So, okay, I put 5 here because this is the most variable that determine the sales growth the most. And then you can also allocate across categories. Allocate your money across categories. Plan and budgets. On the marketing metrics, you need to develop your marketing metrics. What is the leading indicator? The brand. Okay, let's say your plan is more budget into the brand. What is the marketing metrics, the awareness. How many people aware of your product? And what is the financial metrics? Return on marketing investment, etc. So this is the how we manage the resource trade-off. The 5 step for managing the resource trade-off is that you need to identify strategically the relevant metrics. What is the most relevant metrics? Yeah. Assess the relationship between metrics and marketing resources. Do you have the marketing resources? You have the data, yeah, that can identify the measures, and then assess the optimality of the resource allocation decision. So you need to allocate your resources into the optimal return. Yeah. How many percent the sales growth if you conduct your model? And then finalize the resource allocation decision and integrate across marketing activities. So, yep. Okay, so that is on the all resources are limited. Any questions? Questions? So far so good? Kapish or mimai desu ka? Mimai wa mumet. Mumet desu ka? Okay. So that is, so we need in the marketing principle number 4, all resources are limited and an effective marketing strategy must effectively manage resource trade-off. So we need to allocate our budget to achieve the optimal return of the company. We need to allocate our marketing budget to reach the optimal return for the company. That is the objective of this chapter. Araso?
Sure.
All right, good. And then let's continue into the final chapter.